Struggling with stock market basics? You need these 9 game-changing tips. Join Money Smart Basics as we break down 9 tips to master the stock market all in one day. Get ready to invest smart and see real results. Please remember to like, subscribe, and comment for more Money Smart Basics videos. Stay until the end to receive a bonus tip. What's going on, everyone? It's Alfonso here, and welcome back to the channel. Today, we're diving into the exciting world of the stock market. Now, I know just hearing the word stock market can be intimidating, especially if you're brand new to investing. But trust me, it doesn't have to be complicated. In this video, I'm breaking down the basics into 9 simple tips that every beginner investor should know. So whether you're just starting out with a few bucks or you're ready to dive in head first, these tips will help you build a strong foundation for your investing journey. We'll be covering everything from understanding what stocks actually are to managing your risk, and even how to avoid common investing mistakes that can cost you big time. So grab a notebook, get comfortable, and let's get started. Alright, so before we get into all the details, let's answer the fundamental question. What exactly is a stock? In the simplest terms, a stock is like a tiny piece of ownership in a company. Think of it like buying a brick in a giant Lego building. You own that one brick, and as the value of the entire building goes up, so does the value of your individual brick. Now, those bricks are actually called shares, and when you buy shares of a company's stock, you're essentially becoming a part owner. And just like any good owner, you get to participate in the company's success. This can come in 2 main forms: dividends and stock price appreciation. Dividends are like little payments that companies give back to their shareholders. The other way you make money is through stock price appreciation. As the company grows, more investors want a piece of the action, driving up the demand for their stock. And just like with any other product, when demand goes up and supply stays the same, the price goes up. But just like any investment, there's always the risk that the company won't do as well as you hoped. Let's dive into the different types of stock you might come across. The 2 most common types are common stock and preferred stock. They have key differences every investor should understand. Common stock is the most common type. It represents ownership and gives you voting rights. Preferred stock is different. It usually doesn't come with voting rights, but it pays a fixed dividend, often higher than common stock. Preferred stockholders get paid before common stockholders if the company liquidates. Now, before you go pouring all your savings into the stock market, let's get real about the risks involved. Because just like that brand new sports car you've been eyeing, investing in stocks comes with its own set of potential hazards. The biggest risk, and the one that keeps most newbie investors up at night, is the risk of losing money. The stock market is like a roller coaster. It has its ups and downs, and sometimes those downs can be pretty steep. Remember the 2008 financial crisis or the dot-com bubble burst in the early 2000s? Yeah, those were not fun times for investors. Even if you're not investing in individual companies, the overall market can fluctuate, and factors like economic recessions, political instability, or even natural disasters can send stock prices tumbling. And if you need to sell your investments during a downturn, you might be forced to sell at a loss. But hey, it's not all doom and gloom. Remember, risk and reward often go hand in hand. The key is to understand and manage those risks effectively. One way to do this is by diversifying your portfolio. Chapter 4. Start with a plan. Jumping into the stock market without a plan is like setting sail without a map or a destination in mind. You might end up somewhere, but it probably won't be where you wanted to go. That's why having a clear investment strategy is crucial before you buy your first stock. Start by defining your financial goals. What are you hoping to achieve through investing? Are you saving for retirement, a down payment on a house, your kids' college education, or maybe that dream vacation? Knowing your goals will help you determine your investment timeline, how much risk you're comfortable taking, and what types of investments are right for you. Next, figure out your risk tolerance. We talked about this earlier, but it's worth mentioning again because it's that important. Are you a risk taker who thrives on the adrenaline rush of volatile investments, or do you prefer a more conservative approach? Your risk tolerance will play a significant role in shaping your investment strategy. Once you have a good understanding of your goals and risk tolerance, it's time to choose your investment approach. Chapter 5. Diversification is key. You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, that's not just a catchy phrase, it's the golden rule. Diversification is the key to mitigating risk and maximizing your chances of success in the stock market. Think of it like this. If you invest all your money in a single company, and that company goes bankrupt, you lose everything. But if you spread your investments across multiple companies, industries, and asset classes, the impact of one bad investment is significantly reduced. Diversification helps you weather the inevitable storms in the stock market and come out stronger on the other side. But how do you actually diversify your portfolio? It's not as complicated as you might think. One way is to invest in different sectors. Don't just focus on tech stocks or energy stocks, branch out into healthcare, consumer goods, real estate, and other sectors. Each sector has its own unique risks and growth potential, so by diversifying across sectors, you're creating a more balanced and resilient portfolio. Another essential aspect of diversification is investing in different asset classes. Chapter 6. Fees. You wouldn't walk into a store, buy a t-shirt, and then happily pay double the price just because, right? So, why do it with your investments? Fees are an often overlooked aspect of investing, but they can significantly impact your returns over the long run. Every time you buy or sell a stock, there's usually a commission fee involved. And if you're investing through a financial advisor, you're probably paying management fees as well. Even seemingly small fees can eat into your profits over time, especially if you're frequently trading or if your investments aren't generating high enough returns to cover those costs. So, how can you keep those pesky fees in check? First and foremost, be aware of the fees associated with your investments. Don't be afraid to ask your financial advisor or brokerage firm about their fee structure. Consider using a discount brokerage that charges lower commissions or opting for no-load mutual funds that don't have sales charges. If you're investing in ETFs, pay attention to the expense ratio, which is the annual fee charged to manage the fund. Chapter 7. Stay informed. The stock market is like a living, breathing organism, constantly evolving and reacting to new information. To be a successful investor, you need to stay informed about what's happening in the market and the world around you. Now, I'm not saying you need to be glued to CNBC all day, every day, but it's essential to stay up to date on market trends, economic indicators, and company-specific news that could impact your investments. One of the best ways to stay informed is to read financial news websites and publications. Websites like Yahoo Finance, Google Finance, and Bloomberg offer a wealth of information on market data, company news, and expert analysis. You can also subscribe to financial publications like the Wall Street Journal, the Financial Times, or Investors Business Daily for in-depth coverage and insights. Another great way to stay in the loop is to follow financial experts and analysts on social media. Many reputable investors and market commentators share their thoughts and analysis on platforms like Twitter and LinkedIn. Just be sure to follow those who provide balanced and well-researched perspectives. Chapter 8. Think long-term. In the age of instant gratification, it's easy to get caught up in the allure of quick profits and short-term market swings. But when it comes to investing, slow and steady often wins the race. Think of the stock market like planting a tree. You wouldn't expect to see a towering oak tree overnight. It takes time, patience, and consistent nurturing for a tree to grow strong and tall. Similarly, building wealth through investing is a long-term game that requires patience, discipline, and a focus on the bigger picture. Short-term market fluctuations are inevitable. There will be times when the market soars and you'll be tempted to cash in on your gains. And there will be times when the market plummets and you'll want to pull all your money out and hide it under your mattress. But remember, trying to time the market is incredibly difficult, even for seasoned professionals. Chapter 9. Don't let emotions drive your decisions. We've all been there, that heart-stopping moment when you check your portfolio and see your investments in the red. It's natural to feel a surge of fear, panic, or even anger. But when it comes to investing, letting your emotions drive your decisions can be a recipe for disaster. Fear can cause you to sell your investments at the worst possible time, locking in losses and missing out on potential rebounds. Greed can lead you to chase after the latest hot stocks or investment fads, often with disastrous consequences. Remember, the stock market is driven by both rational and irrational behavior. When you let your emotions take over, you're essentially letting the irrational part of your brain make decisions about your hard-earned money. So how can you keep your emotions in check and make rational investment decisions? First and foremost, have a plan and stick to it. We talked earlier about the importance of having a clear investment strategy that aligns with your financial goals, risk tolerance, and time horizon. When you have a plan in place, it's easier to tune out the market noise and avoid making impulsive decisions based on short-term fluctuations. Another helpful strategy is to focus on the long term. Outro start investing today. So there you have it, folks. 9 essential tips to help you navigate the exciting world of the stock market. Remember, investing doesn't have to be complicated or intimidating. By starting with a solid understanding of the basics, staying informed, and staying disciplined, you can set yourself up for success. If you found these tips helpful, be sure to give this video a thumbs up, subscribe to the channel for more investing advice, and hit that notification bell so you don't miss any future uploads. And as always, feel free to leave a comment below with your own stock market tips, questions, or any topics you'd like me to cover in future videos. Until next time, remember to invest wisely, stay informed, and keep building that financial freedom. See you in the next video. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promise. Did you know 70% of beginners feel overwhelmed by stock market info? Here's a tip: focus on one stock at a time. Avoid getting swamped by too much info. Remember, every expert was once a beginner. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like, subscribe, and comment for more Money Smart Basics videos.